GCW outer square trader. Michael, it's 12:09. How are we doing?
12:45 will close. Okay.
Yes, sir. Yes, sir. The outer square.
Can you hear me?
Yeah, brother. Go ahead.
All right, man. Well, Kit, thanks for what you do. And Michael, your generosity is legendary. I've been listening to you for, I don't know, 3 years or so now. I take what you teach, I go try to learn it, put myself in a hole and learn it for a while and then come back. One thing I have struggled with repeatedly is just kind of finding a balance between liquidity pool draws and in-wogs and in-dog draws. If I remove all the candles, it's really easy to see how powerful those gaps are. And just incorporating that into my analysis, can you give me, like, I know you've talked about this, and it's probably because I'm retarded, I don't quite get it, but can you give me a sort of a general idea, an analogy? You're really good at those analogies of how should I frame that in my head? Because sometimes I get it right and sometimes I just don't. And it's just hard for me to gauge the different strengths of draws, particularly liquidity pools and the gaps.
Well, if you have the last 5 new week opening gaps on your chart, and there's your canvas. That's your highest high NWOG, your lowest low NWOG. Okay. And then incorporate what you think the market's reaching for on the weekly and daily chart, just by price alone. Did it just recently take liquidity on the weekly and daily? Is it gravitating towards a clear, obvious little imbalance that might be reaching down into it? And does it afford you 100 handles or more? Then what you want to do is just go down to the lower time frames and then refer to any one of the most recent new week opening gaps. If it's reaching for something lower because of the weekly and daily chart, we're assuming that we're bearish now because of that. Waiting for price to run up into an NWOG and then respect it by staying in the lower half of it. It can throw a wick up in the upper half of it, or it can trade up in the upper half of it, but then leave it again, go back below the low of the NWOG, and then trade back up to the consequent encroachment, or fail to do so, the next fair value gap, just use that as a draw to your daily or weekly inefficiency. You can play ping pong, literally have no bias at all, zero bias, just trading every reaction off of every NWOG that's happened in the last 5, and just simply study. Take everything off your chart. All of you should be doing this. Take everything off your chart and just put the NWOGs on. And just study how price reacts. How many times are you getting a setup? You're not getting a setup every day, but you're getting intra-week price runs for several hundred handles. You're getting a forced perspective of patience because this is the only time you can take a trade. And if you are trading against the higher time frame bias that you could arrive at by using a weekly and daily chart, trade with one contract. But then do your regular high-end maximum leverage when you're trading in concert with your high time bias, where you're reacting off of one NWOG and trading it to another one as a target. Like, there's so many ways to skin a cat, man. Like, there's so many ways to do this stuff. And I'm concerned that when I present something, when I teach something, because the folks that listen to me have like this almost like a, it is cult-like. It really is. It's kind of weird. But you think that everything I'm saying somehow supersedes and improves upon and makes the previous stuff irrelevant and it's obsolete now. So this is the only thing you got to worry about, or add this and it's all going to suddenly become easier for you. And you got to go back to step 1, which is, why should the market go up or down? It's going to have a reaction off of absorbing liquidity above old highs or below old lows. Right away, you have a test tube right there. You have a laboratory experiment. It just took out an old high. Does it continue, or is it rejecting it? If it rejects it, then what do you have? You have a likely 2022 model. What's the closest proximity, new day opening gap or new week opening gap from that high forming? What's the closest one? Aim for that. And then the nearest 25 or 30 handle swing low or inefficiency below that, take that as your first partial, move the stop to cover cost, maybe a pizza dinner, and let it go. There's a model in and of itself there. Like there's so many ways that you can trade liquidity because it's all over the place. Like there's so many opportunities. There's no limit to what you want to do in terms of framing your model. But unfortunately, what happens is, and I see this a lot, so it's not just something that's unique to you. Everybody wants to have the perfect model, the perfect, never losing, always easy to do. It's going to be the same way each time. And that's all they got to worry about. And they can disregard all this other stuff. They don't have to worry about 80 more PD arrays. They don't have to worry about another, bias techniques. It's just this. It's because they had not spent enough time doing something as boring as looking at one selection tool. What's making you bullish or bearish? Are you going to be a liquidity or an inefficiency trader? Answer that for me right now. Where are you finding yourself drawn to more? The gaps or highs and lows where liquidity
The
exists
highs
above
and
and below?
lows, there's no doubt. Liquidity is what makes sense to me, like right away. Immediately it did.
Okay, so now we have that out of the way. What is your technical entry model? What's the PD array that puts you into a trade? What's the thing that gets you into a trade?
I look basically for the 2022. I look for the displacement and the return, the fair value gap, and enter there.
Okay, so you're looking for a premium fair value gap in the displacement leg after a run on liquidity.
Yes, that's what I really like. I feel good about those.
Okay, so when you see those setups, why are you even considering that trade? Where do you think it's going to go?
I'm looking for, well, if after it's just taking liquidity, I'm looking for an SMT reversal of some. That's what I'm looking for.
No, don't even worry about that.
No.
Where is the market going to draw to? What do you want it to go down to? If you taken
Oh, the
time to watch the
draw.
market, yeah.
Gotcha. I'm looking. I'm looking for some displacement down further to that it's going to reach down there. That's typically what I do. Where's a big displacement candle, and I kind of use that as a target, or
Okay, paint
50%
paint a
of the
scenario
range,
for me.
something like that.
Okay, what range?
The dealing range that precedes it, that brought it up there to take the liquidity in the first place.
Okay. Okay, so let's assume for a moment there was a 300 handle run that ran that high out, and then it created a false breakout, and then it displaces lower. It leaves a fair value gap, so you know you got an entry for a model 2022 entry. You have a defined easy placement of a stop loss, and now you're looking for that 300 handle run up, that price leg that went up there, created that reversal or potential reversal. You're aiming for 50% or potentially around 150 handles, correct?
Yeah, more or less. Yeah.
Okay, now what would happen if you had a new week opening gap high that's just about 20 handles below 50% of that range that you're talking about? Would you just get out at 50% of the range, or would you aim for in logs high?
In that instance, I would aim for the MWOG high, because that
See how easy that is?
it's not going
That's
counter
how.
to my. Yeah.
Right. That's it. All you're doing is taking the tools and placing them in their proper place. Every tool, if you've ever been around someone like I'm a car guy, and a lot of my neighbors, they have really nice cars too, and they have their little shops, and it's wonderful. They have all these tools. I'm not a mechanic kind of guy, but every tool has its place, and they always say the same thing. Every tool has its place. In trading, it's the same thing. You're going to look for an NWOG to support an idea, and it may give you a little bit more juice in a theory that you thought was going to deliver, and you're like, oh, you know what? If it's going to drop down there, the NWOG is going to have a whole lot more desire or draw or gravity, basically, to pull price into that than just some 50% of a range. 50% of a range is in and of itself nothing. But when you bring in a new day opening gap or a new week opening gap or an old relative, I'm sorry, an old regular trading hours opening range gap, because they're the same thing as a new week opening gap. They're the same thing as an end dog. They are huge pulls of gravity where it drags price into it because it's forcing fair value in the marketplace. Whether there's enough buying and selling pressure or not, it's being drawn into that. So you've you've illustrated your potential to see it, and I was testing your decision making process by having a scenario where Yes, you know you're dealing with your model. You know how to get into the trade, and you know you're looking for a displacement lower. You want it to go lower, at least half of the range that it, built up the sell-off entry on. That's nothing wrong with that. In and of itself, that model's perfect. But your question was, is the NWOGs and where to, what to do with that? Bring them in as an addition to something you already arrived through regular price action in the model you're trading with, and you'll see that they will drag price in and pull them into a farther objective, a best case scenario exit terminus that you otherwise wouldn't have considered if you were just looking at this half the range or it's just some kind of little fair value gap in the previous run up. Does that make sense?
Makes sense, brother. I appreciate it. That actually does help clarify.
Awesome. Thank you.
Thank you.